Welcome back, ladies and gentlemen. As I was saying earlier, the next set of panel discussion is going to share insights on identifying the leaders of the next bull run. Now, for this panel, we have our very eminent speakers. Let me introduce them to you. Mr. Anirudhha Sarkar, the CIO and Portfolio Manager at Quest Investment Advisors since February 20, and brings with him over 15 years of experience in the capital markets with diverse role managing money for investors across PMS, AIF, and advisory business. Mr. Sarkar holds a bachelor's degree in commerce and an MBA in finance. He has an eye for sector themes and has been instrumental in catching many themes early on in their life cycle over the years. Prior to joining Quest, he was with IIFL Group companies for over 11 years, and at IIFL AMC in his last role, he was the portfolio manager for IIFL Multicap PMS since its inception in 2014, where he had generated industry-leading performance over the 5 years till December 2019, and the same was also recognized in industry awards in 2019. We extend a hearty welcome to him. We have with us Mr. Rajesh Kothari, who is the founder and MD of Alpha Accurate Advisors. He's the visionary behind the customer-driven and excellence-based approach. A CWA and an MBA by qualification, he has a rich experience of more than 20 years in the Indian capital markets and has handled several investment projects in premier investment institutions. During his tenure as a fund manager at DSP Merrill Lynch Fund Managers, now DSP BlackRock Investment Managers, the equity assets under management flourished from US dollars 100 million to US dollars 1.5 billion. All through this period of 5 years, the equity schemes often ranked in its first quartile ranking by CRISIL, a Standard & Poor's affiliate. During his tenure as director of Voyager Investment Advisors, a USA-based India-dedicated fund, the fund outperformed the benchmark indices significantly. Not surprisingly, ladies and gentlemen, Mr. Rajesh Kothari has received many awards and accolades for the same. We extend a very warm welcome to him as well. We have with us Mr. Vikas Khemani, the founder of Carnelian Asset Advisors and has 23 years of capital markets experience, most recently as the CEO of Edelweiss Securities Limited, where he spent 17 years incubating and building several businesses to leadership positions, including institutional equities and equity research. With a strong business acumen and deep understanding of the capital markets, he enjoys strong relationships with corporate India and is associated with several industry bodies and committees, including the CII National Council on Corporate Governance, FICCI Capital Markets Committee, Executive Council of Bombay Management Association. He is also a member of Young Presidents Organization, YPO, a global forum for entrepreneurs and CEOs, and was awarded Young Professional Achievers Award for the service sector by the ICAI in 2014. We extend a warm welcome to Mr. Vikas Khemani. Ladies and gentlemen, this panel will be moderated by Mr. Mohit Bhagat, a senior financial services professional. Mr. Mohit Bhagat has an experience of over 20 years in asset and wealth management businesses in India. He is the head of channel business development at Alchemy Capital. He has served in various positions and geographies with firms like ICICI Bank, ICICI Prudential Mutual Fund, Franklin Templeton MF, and academically, he is an MBA in finance and an IIMC alumnus who has been associated with Alchemy Capital as head to their channel business since January of 2017. A very warm welcome to you, our moderator, Mr. Mohit Bhagat. And now the proceedings are in your able hands. Take it away, sir.
Thank you very much, Aishwarya. Thanks for that elaborated introduction for the panel as well as mine as well. So interestingly, guys, the topic out there or the tagline for the entire webinar, which is the mid-year webinar, goes as in summer of 22, equity is in the air. And I think we all on this webinar are agreeing there's no differences about the fact that equity is in the air. Now that brings us to the most interesting and the most intriguing question which comes next, that if equity is in the air, then what in equity should be looked at? What are the winners to be? What are the winners of the coming outlook would be? And that essentially is what interestingly has also been the topic for this panel discussion that we have today. And while the topic of the panel works around the fact that we are trying to look around, which are the fastest return producing sectors or themes or areas, in a simplistic manner, we're going to kind of put it up to our panelists out there to guide us through this overall understanding of, what they think, to this important question of within equities, which will be the leading sectors or themes or areas that they feel so. And I'll also like to understand from the point of view that while they think that there is a certain area which is the most prospective one, what actually supports, what's the rationale out there? With that, what I would do is I'll basically start it up, by asking the core basic question on the topic itself. And let me start it by Anirudh, and I'll come back to the others as well. So Anirudh, going back to the basic question, equity is in the air, no disputes, right? But within equities, what's the most prospective pocket or island of, I would call it wealth that seems to be coming through in the coming runs?
Yeah, thanks, Mohit. And I think, I would completely agree with the whole thought process that I think, after an excellent period of the last 18 months, which we had seen, obviously the last 6 months have been a bit on the rough edge. But I would say definitely equities is something which is in the air. And considering the way the valuations have corrected in the last 6 to 8 months, I would say that it has become all the more attractive. But having said that, one thing is very clear. Unlike the last 18 to 24 months, wherein, everything under the sun went up and it didn't really matter what you bought. It just mattered that you bought something. I think the next 18 to 24 to 36 months will be very, very important. Which sectors you're betting on, which sectors you're also avoiding. Having said that, I would say the main underlying thought process which I have is I would bet on India more from a domestic side and less from an export side. For the very fact that I think outside India, things continue to remain a bit on the weaker side. And that is where I would say betting on India right now or the domestic consumption side is where I'm putting my eggs. The first sector I would bet on is definitely banking and financial. The reason for that would be very, very evident. If you're talking about, India going to a 5 trillion economy in the next 5 years, I think it's inevitable that the banking sector has to do well. It's a very old, I would say, thought process. Practically all of us would be having banking in our portfolio. But having said that, I would say the valuations are something which has definitely come off the historical averages. In fact, right now we'll be seeing most of the banks quoting at, below the 10-year averages on their price to books or any other multiple you pick up. And the way we are seeing, the whole banking sector come out of the woods after the pandemic, I think, now all those pessimistic thought processes are now behind us. We are seeing I would say the retail, lending growth also has picked up. The housing finance is one space which I would say is definitely going to be a very, very strong piece within the banking and financial. And I would say that continues with our thought process of being very bullish on the real estate side. The second sector, as an extension of what I just mentioned, is, I would say, the housing side, the real estate. That is the second sector which I would put my bets on. And that continues to be one of my overweight stands for the last 15 to 18 months. And that continues even now. I believe it's a long way to go for the entire property cycle, which we had seen as a bad patch for, I would say, a bigger part of the last 6-7 years. It had gone through that bad patch. We have been around 15 to 18 months into the good cycle of the real estate sector. I think we have a decent runway for that sector to continue to play out over the next 18 to 24 months. Demand continues to be very, very strong. There is no shortage of demand. We met a couple of, I would say, companies which are in that space, a couple of intermediaries who are in that space. There's a decent demand which has not seen tapering off even after the interest rate hikes. In fact, most of us on the street were a bit concerned that after the interest rate hikes, we could see some demand tapering off, but that doesn't seem happening. So this is the second sector I would bet on. And the third sector I would bet on is autos and auto ancillary, which again is more of a domestic consumption story. And I would say that after a decent 18 to 24 to 36 months of a bad patch in that auto space, we are definitely seeing the demand coming back in that space, not just in passenger vehicle, but across the two-wheeler, four-wheeler passenger vehicle. And if we are bullish on the whole economic activity picking up, I think the CV cycle is also ahead of us. So this entire auto space is something I would be very bullish on. And thanks to the commodity prices coming off, I would say companies who have taken a decent price hikes in the last 6 to 8 to 9 months will see their margins also improving in the quarters coming ahead. So to put it in one line, I would say I would bet on the India consumption story, banking, the real estate, and autos.
Okay, thank you. So Vikas, as Anirudh has already, kind of taken his bet on the three that she has spoken about, we'd like to take your views on the same.
Sure, Mohit. I think, if you see this question answer will probably change depending on what time horizon. If you ask me next 12 months, what will be the leading sector would be different than, 3 to 5 years. So I think for the purpose of, I would just say probably we are looking at next 3 to 5 years kind of time horizon. And if you see in last 18 months, lot of sectors, as Anirudh was saying, everything did well because it was liquidity driven. Everything, when the water level goes up, everything goes up. And that was the nature of the, and I think last 6 months has really cleared the froth. Only sectors which are solid, earnings driven, cash flow driven are kind of holding on and will do well. Secondly, so I feel that I think as India is one of the in a best position from all perspective, I think will be very, very less impacted with what's happening globally around, and in some sense beneficiary of what's happening globally. So from a sectoral perspective, as we see next 3 to 5 years, some big themes which come out very, very clearly. One is I think banking and financial services, as Anirudh also alluded to. But my sense is that there are 2 or 3 reasons which are apart from the India being a big opportunity and the sector has not performed in last 4 or 5 years, but more importantly, what cleaning up has happened in last 4 or 5 years. I think India's credit cost has structurally gone down, which is I think probably only first time happened in last 20-30 years. When 2007-8 retail credit crisis happened, we did not have CIBIL infrastructure. 2009-14 corporate credit crisis happened, we did not have IBC infrastructure. And in last 4 or 5 years, we have had a huge data-driven sort of analysis of the credit started happening. So a lot of tools have got built, a lot of infrastructures got built where the fraudulent activities are very difficult to happen and backed by the CIBIL and IBC infrastructure. I think one thing has clearly changed structurally for the sector is that credit cost has come down. And that will, of course, while bring the margins down in the banking industry, but profitability will not come down. Profitability will probably sort of get better. And I think that's a very big reason. I think, in my opinion, over the next 3 to 5 years, also sector can do well as the growth comes by, as market realizes this factor that the riskiness in the sector has gone down drastically as compared to any of the previous cycles. And you will see sector getting re-rated as well as the earning growth happening. Second very big sector, according to me, or theme rather, I would say, in India, one has to look at very differently how manufacturing is looked at before pandemic and post-pandemic. We know that because of the government's focus on making India self-reliant, also additional factors like China plus one, creating a demand factor significantly, which was not in the same size and proportion before. India used to export, but we are seeing exports have significantly gone up, right? And there's a very, very big driver which is taking place. So both on the import substitution and export side, especially in the manufacturing side, is very, very well placed. And India's cost competitiveness vis-a-vis China has significantly changed. India's labor cost is $250, $200 to $50 a month. In China, $750 a month. Our power cost is same. Logistics cost is getting better. So India has also improved drastically on the competitiveness front. So I think this time around, I think our manufacturing renaissance or manufacturing boost over next 3 to 5 years, maybe more, would be very big. Our manufacturing GDP, which is about only 16% of the total GDP, can go to, government is of course saying 25% is the target, but even if we look at, let's say 20% of the target, which is a conservative target, I think we will double our manufacturing GDP from $450 billion to $1 trillion. Now within that, you can see when this kind of growth happens at a GDP level, you obviously see sectors, companies growing much faster than that, and this cuts across both again import substitution and exports. It cuts across APIs, chemicals, textile, auto component, defense, and many more sectors, right? So I think here there's a very big change happening underway, and this is here to stay. We will see in fullness of time. Many companies which are today, a few thousand crore can become 10x, 20x because the tailwind is very, very high, and this time it looks like pretty sustainable. And related to that would be, in my opinion, of course, the capital goods sector, because in India we've been waiting for capital goods capex cycle waiting to happen for last 10 years. We are beginning to see if our manufacturing GDP has to double, or to $1 trillion, we will need almost close to $200 to $250 billion of capex, which means $50-60 billion, $80 billion a year, which is a very large number as compared to past. And I think this acceleration will again create massive opportunity. And capital goods stocks perform in cycles. If you see, whenever the order book starts getting built, they will obviously always do well. And if you look at from the previous cycles as well, whether it was 2003 to 4, capital goods sector did very well in that whole 5-6 year period cycle. And I kind of see similar getting repeated. And the last but not the least, I think consumption side, India is improving its per capita income. Our job creation is getting better both in the IT sector as well as in the manufacturing, which we spoke. So I think the acceleration in the job creation which is happening, per capita income is going up, aspiration of Indian population is going up. So I think in the discretionary consumption space, we will see a massive opportunity. I think this is unlikely to sort of go away in any time, and it can remain for the next 10-15 years because we are a very young society, young population, and we are also aspiring or aspirational society. And if our per capita income is beginning to sort of accelerate or rise, which is the case, I think we will see a massive sort of opportunity space. So I think these are the 3-4 broader segments. I see a broader tailwind, and within that, massive wealth creation opportunity happening over next 5 to 7 years period, or maybe longer.
Wonderful. While you stated that, Vikas, small clarification, on the capital goods, while you're mentioning about, what is the focus area or what's the emphasis area? That's public capex or private capex, or you're talking about a combination of both?
It's actually a combination of both. And very interestingly, your question asks, of course, public capex would lead, because in a cycle like this, public capex would lead. But what government has done with the announcement of almost 170,000 crores of PLIs, it has incentivized private sector to come ahead and sort of go for the capex. Secondly, recently I was listening to ABB chairman. It's a very big change which has happened in like past. This is earlier cycles, we were focused on capex, which was large scale capex, 10,000 crore capex, 5,000 crore capex. This time around, the capex focus, ABB kind of companies focusing on a capex, mid-market capex, which is 100, 200, 500,000 crore capex. So we are seeing a massive build out of happening of capex in this segment. So if you look at an API company is doing capex, they would do 500 crore capex. If a textile company is doing, they are not doing 10,000 crore capex. They will do typically 200, 500 crore kind of capex. So this segment is also a very, very large sort of fastest growing segment, unlike in the past. So probably you will start with this, and eventually I'm sure we will also see large scale capex in the core industries, which is still not sort of coming in a big way. But companies like JSW, Tata Group, everybody's announced now a large scale capex also, which will probably take some time to come. But I would say combination of both, and this time around even SME and MSME will participate a lot in that.
Sorry, I'll just keep Rajesh on hold for a few more seconds. And one more point that while you mentioned this, while you're talking about this capex to be happening out there, while you mentioned ABB and all that, you think this capex is actually capacity expansion, or it is in form of a technological advancements, which is basically taking place out there. So all am I trying to look at is this actually adding to the productivity out there, or it has just been the technological advancements which is replacing the old set of production bases to the newer ones?
Mohit, I think it's a very, very good question. See, it's a combination of both. First of all, I think our capacity utilization, if you see across the board, has gone up. Right? I mean, we are upwards of 75% kind of pretty much most of the sectors kind of capacity utilization. We need capacity across the board. Now, what's happening is when the new capacities are coming, they are no more coming with the new capabilities. They're old capabilities. They're coming with a lot more advanced capability, automation, because everybody knows that there's no point in going back with the same kind of expansion. And as the new capacity goes up, it will be advanced, new. I mean, there's a company called PCBL. Their next plant is Industry 4.0, right? While they are building a new capacity, but the plant is and Infosys is working on that. So you can see now how the traditional IT, traditional capex or traditional engineering along with the IT support is going. So definitely every company is focusing on automation, productivity expansion. But so it's a combination of, and as and when some amount of earlier capacities also will have to be upgraded. So again, it's in my opinion combination of both. But definitely industry is looking for the new sort of way of manufacturing, unlike the past.
Thank you, Vikas. Rajesh, up to you. So it's been a long wait, sorry. But then the idea is that while we basically had heard both Anirudh and Vikas out there, would like to definitely look at your views on the sectors or the themes that you feel are the triggers of or the winners of the coming times.
So first of all, thanks Mohit, for coordinating these entire efforts, and thanks to PMSAIF for inviting me on this panel. I think these are continuous efforts by PMSAIF World to organize such summits in the interest of investors. Mohit, let me connect where probably Vikas ended. I think the Indian capital goods, the entire sector is going through a complete change in landscape. 10 years back, I remember during my DSP BlackRock days, when anybody talks about capex, people talk about irrigation, people talk about thermal power plants, people talk about railways, they talk about road construction, and many more such related things, power, transmission, distribution, and many more such things. But today, apart from these traditional areas, which grow at probably at the GDP rate, there are new growth areas. There is data centers. It's the renewable energy. It's the robotics and automation. It is about efficiency-driven capex. So, for example, if you look at data center, that itself probably will become 50,000 crores capex over next 5 years. If you talk about renewable energy, probably India is targeting roughly 500 gigawatt, if I'm not wrong, by 2030, compared to current 157 gigawatt. If you talk about the robotics, I was talking with one of the largest company, multinational company, and he was saying there are only 6 robots per 10,000 workers in India, compared to 100 plus robots. I'm not talking about versus US, compared to even China and many other emerging economies. It is this kind of a capex, the new growth areas, which is going to drive the wealth creation. And mind you, the last capex, if you look at 2003 to 2006, 7, 8 cycle, the BSE Capital Goods Index went up by 15 times, compared to Sensex going by 5 times. So, but what happened after that is that banks came under problem because entire capex, many of it became NPE. Whereas this time, the capex is efficiency driven. It is not just addition to, we need to play the right companies, of course, within it, so that you don't get the bloated balance sheet. And that's probably kind of a difference, probably a fund manager brings on the table when he's doing, of course, the stock selection within that. Coming back to your question in terms of the sectoral trends, while the panels, Vikas and Anirudh both have talked about few sectors in which I agree to them. One sector, probably apart from banking and auto, which we like, is specialty chemical space. This is a space probably which is a little bit more structural play. So while most sectors you need to take view every year, probably this is a sector where there is a visibility for next 2, 3, 4, 5 years. The India's market share in specialty chemical sector is still at significantly lower levels compared to where China is, correct? If you look at the top 10 companies in Indian specialty chemical sector, their capex for next 5 years is equivalent to their capex what they have done in last 10, 15, 20 years. So that gives you kind of visibility what the chemical companies probably are getting from their customers. Our proof in terms of products, our proof in terms of the product purity, our proof in terms of the cost competitiveness, our proof in terms of the scale, India has already came to that level where they are getting a lot of attention, a lot of traction, actual orders from the global customers, be it Japan, be it Europe, or be it USA. And these are really long-term contracts. These are the contracts where, probably the return on capital employed is going to be 20, 30, and probably even 40% plus. So it's really very, very high domain, India enjoys. One more important thing, rather than just talking about the sectoral trends, let me right now tell you how to spot sectoral trends. Because, everybody, on this panel is sharing that, okay, we are bullish, for example, we are bullish on auto, we are bullish on banking, we are bullish on capital goods, we've been early invested in specialty chemical. But how to spot these opportunities, and that's probably is more interesting. And therefore, you look at the business cycle approach. So if you look at, for example, the earnings growth, because market is very simple. It is a mirror of earnings growth, So last 12 years, Nifty has delivered 8% compounded earnings growth. And in last 12 years, Nifty has delivered 10% compounded market cap returns. So earnings and market cap, they always go hand in hand. And therefore, it is very important to check the earnings growth when you are investing into a sector. Say, for example, automobile sector. This sector is reported 3% earnings growth in FY22. And this sector is likely to report 39% earnings growth, excluding Tata Motors, in FY23. Say, for example, the consumer discretionary is a space on which we are extremely bullish. In FY22, the sector is reported 20% earnings growth. In FY23, the street expects roughly about 40% earnings growth. Banking, from 40% high base of earnings growth, we expect FY23 to continue to report strong 25% earnings growth. Capital goods continue to do 25% earnings growth. So you need to put your money where the mouth is, So these are the sectors which are going to contribute significantly to the street consensus expectation of 14% nifty earnings growth. If you look at the draggers, for example, cement probably is going to report flat to negative earnings growth. For example, metals, very high probability that sector may report negative earnings growth after reporting 200% plus profit growth in FY22, correct? If you look at the defensive, like staples, they are going to report 10 to 12%. They are very neutral, very kind of a steady base kind of thing. So earnings growth is something very, very important. And if one can identify that from where the earnings growth of which sector is going to contribute highest to the nifty earnings growth, there is one way to identify spot the right opportunities and participate in the wealth creation journey for short term, medium term, as well as long term.
Thanks, Rajesh. Anirudh, this brings me to a very interesting question, and it's like a deja vu kind of a situation which brings it to us, saying that, there's a saying in the market which says that every new bull run has its own new set of leaders, new pack of wolves. And this seems like happening because in the past, if you basically look at the last one that we've just gone through, the leader of the pack were IT, pharma, specialty. I mean, Rajesh did mention specialty chemicals, and I suppose I'm just going to ask him an overarching question there. But, beyond that, broadly, none of you guys have actually even touched upon very near to IT or pharma or the previous, pack of bulls, which were basically, in the front runners in the last run-up, right? Do you think that this is something that is consistent in the going on fashion and this is going to work through this time also? Because what I hear out from most of you guys, there's a consensus forming up on banking, auto, capital goods, discretionaries, right? More or less, these are the sectors where you guys are forming up consensus onto. Now, while we're looking at this consensus, what is basically happening to the erstwhile sectors, like, for example, IT, pharma, right? So if you can just throw some light on that.
Yeah, I would say, sector rotation is something, which, I have been following for a very long time. And it's not something, which any of us would have discovered. If you go back in the times and see over the last 18, 20 years, each bull run had a different sector, as you rightly mentioned. 99, 2000 was all about the IT stocks, wherein, all your old economy companies, they did not do well. The next bull run of 2005 to 2008 was all about the old economy companies and sectors, your infra, cap goods, the real estate. And during that phase, you had your FMCG, pharma, which underperformed. If I just come to the period before pandemic, you had all the consumption, the growth oriented, your Asian Paints, HULs, Pidilites of the world, which were the hot, I would say, the outperformers. And you had your cyclicals underperforming. Within 6 months after the pandemic, the hands changed. Cyclicals, metals, the real estate, PSU banks, they started doing exceptionally well. And the same consumption, the growth-oriented sectors, which were doing well in the previous cycle, they underperformed. I would say the same is being seen in IT and pharma also. If you see, for most part of 2020 and the first half of 2021, you saw massive kind of a P multiple expansion, which happened in the IT stocks and the healthcare space for obvious reasons. Like, your entire IT pack, which was growing at, say, 6-7% kind of an annualized earnings growth because of the pandemic, because of the migration to the cloud, because of the opportunities which opened up internationally. I would say we saw our Indian companies' earnings growing at 15, 18, 20, and in some cases even 25 to 30%. That led to a massive P multiple expansion. Same thing because of pandemic, for obvious reasons, we saw the pharma companies and the healthcare companies getting a massive multiple. Now, the mean reversion is something which is a very, very important part which happens in the market. And I would say what we have been seeing for the last 6-8 months and could continue for, I would say, the next 4 to 6 months also is a time correction wherein the valuations of these companies come towards the mean. Some part of that we have already seen in many of the IT stocks. We have seen the IT stocks underperforming for the last 6-8 months, pharma stocks underperforming. A large part of that mean reversion is already underway, but I would say some amount of time correction will continue for some time, wherein you see this mean reversion playing out. And I would say these sectors, both IT and pharma, they will not disappoint on earnings. That's for sure. Their earnings will continue. But I would say that P multiple expansion, which was visible for most part of 2021, that might not be visible, and that could continue to get reflected in the price points.
Okay, thank you. Rajesh, in extension to the earlier point, which you made on very interesting point that you made on cap goods. Now, when I talk about specialty chemicals or cap goods out there, how much do you think that this overall geopolitical advantage like China +1 or the PLI schemes or such things are basically contributing out there? So is the sector movement that we're talking about based on these advantages only, or you think that there is fundamental catch-up that's also kind of inbound coming in?
Very interesting question, Mohit. And I think for both the sectors, there are some commonalities and there are some non-commonalities. Now, what is happening is that the China +1, it is just not because of China +1 things are going to happen, correct? But if you look at the India's government entire efforts, I'm talking about the capital goods sector here, is to become self-reliant, because right now we are importing a lot, correct? So across the sectors, there is a movement to improve the self-reliance. And that, of course, requires capital expenditure. Say, for example, if you are buying air condition, basically, right now we are importing 100% compressors, correct? Probably if you are consuming even a simple medicine like Crocin, you don't know, probably the API comes from China. We are 100% dependent on China. Now, clearly, of course, this is not the right long-term strategic thing. It's not in our favor. And we need to change that. And that's what effort is by government. Whether you look at defense, whether you look at the healthcare, whether you look at the capital goods, whether you look at, across the sector. So the good thing about India is that we have a large domestic market. So that gives natural economies of scale to the enterprise, number one. Number two, globally, what is happening? Globally, not only China, the US, Europe, China, everybody is becoming more and more tight in terms of the pollution norms, number one. Number two, their in-house efficiencies, the cost of production versus India is now not favorable. If I'm talking with, Cummins, 1.5 months back, we had a webinar with, Cummins MD, and he said that there are now 3 plants globally. You have North America, you have China, and you have India. These 3 plants will cater to the entire world markets. So it is not about India versus China. Wherever India is competitive, in particular Cummins portfolio, India will be the exporter to the world market. Wherever China is, China, India may import even from Cummins China, because if India is not competitive, we will not produce. Very simple. And if North America is cost competitive, then North America will cater to the world market. This is increasingly becoming the global trend. If I talk with Schaeffler, if I talk with Timken, if I talk with 3M, across the board, we are seeing this kind of a voice that they are basically mapping out which country is most efficient. Now, moment I ask them this question, that are you trying to say India is not competitive? Why not in other products? Why only product A and why not product B? And their answer is very easy, is a very easy solution. Because India market in few products is not yet developed. So to make India as a base, say for example, for product C, which right now India is importing from China, India market is very, very small. And therefore India cannot afford to set up a plant for that particular product C, because our volume is only 10 units versus minimum units requirement is 1 lakh. Whereas for product A, India is already 90,000. For them, Cummins has to put probably only 30,000 additional capacity to cater to the world market. So I think it is not that just easy equation of China +1 kind of thing. It is a combination of all these things which are coming together. And that is what basically leading to the better capacity utilization. If I go by the recent RBI data, our capacity utilization at country level is already crossed 74%, which is a good number. And at 70% plus, everybody needs to do capex, whether it's a greenfield, whether it's a brownfield, whether it is efficiency capex. The good high metal prices is also very important for capex driver, because metal companies, they put huge investments, and the metal prices have been doing extremely well in last 2 years. They made probably 10 years profit in 1 year. So clearly they have already announced their plants, whether it is a cement, whether it is a metal, whether it is a renewable energy, and many more such things. So I think that's basically happening in capital goods sector. If we talk about the specialty chemical space, it is not about China plus one. In fact, you will be surprised to hear that many Indian companies are exporting to China. Many Indian companies are exporting to China. Okay. So India is becoming really very, very cost competitive. We have a basic intellectual because we are all good chemistry and engineers are very high. That's good. We already have the natural economies of scale advantage because our Indian market is already providing some minimum scale what is required. And on top of it, India has also proved that on pollution norms, standards, also we are equally good. So product purity, the R&D, for example, SRF. There are 300 patents. SRF has already filed 300 patents. They already got 93 patents under their approval already. Probably, if I'm not wrong, they were 400 plus employee in the R&D department. Now that's what is required. Specialty chemical is all about product innovation. It is all about patents, R&D, and the support. And apart from that, you require backward integration and you also require forward integration. For example, fluorine, extremely dangerous chemistry to handle. It's not very easy. There are only 3 players. Globally also, there are limited number of players. If you look at amines, there are only 2 players in India. There are not 5 players. It's a 2 players market, correct? So India is absolutely very, very competitive in few chemistry. And that's what is driving the specialty chemical growth for our country.
Fair enough. Vikas, let's kind of, move down a little away from this. And I'd like to take your focus to our experience as investors, right, in the last 2 years on the new age businesses. Now, we've seen this flurry of new age businesses coming out, getting listed in the market, some plethora of valuations being talked about. And then since then, we've also seen the roller coaster ride of these valuations. And probably, I don't know, but you're the right guy, but maybe I feel that we are at the lower arc of that valuation drive. So how do you see this? How do you see new age, overall companies been contributing that ways? And is there an area that one can look at?
I think no doubt about the fact that
Has not been able to hear you.
Are you able to hear me now?
Yeah, now, right.
So there's no question or doubt about the fact that some of this new age, new way of doing business is here to stay. They will change the way business was done. There will be disruption around. There's no question on that. The only challenge in this that in last 2 years, because of again huge amount of gush of liquidity, the way these businesses were valued was crazy according to me. And this happens every 5-10 years in different segments and sectors. The euphoria gets built around the new thing, and that sustains for a long period of time until it becomes a bubble. We saw that in .com bubble around 2000. Now, if you just look at, that's a very interesting analogy I can give. That internet as a technology, when it started becoming relevant into 99, 2000, 2001 period, it was a solid technology. But, and the companies like Google's and all those things were being incubated, created at that point in time. But in whatever companies we saw in 99, 2000 era, did not sustain scale up or were the next leaders, right? I mean, you saw a very different set of companies coming about and building the whole. So same thing. I think, in my opinion, there was a lot of euphoria. There was the way companies were valued, and when companies gets valued in that kind of manner, they also end up damaging the business plan, entrepreneurs, and the core purpose of the business. So I personally believe that whatever companies we have seen in last 2-3 years getting listed, many of them will not even survive and will be listed in probably the next 3-5 years. I mean, that I have said consistently in last 12 months, in many my media interactions. And we have seen that in 2005-07 cycle, we saw many infrastructure companies were valued like, crazily. And then we saw many of them don't even survive today. Because the fact that many of them don't even have a business model. And business model itself is getting changed and disrupted. On the top of it, we are giving valuation, which is crazy. So definitely companies will emerge, in the new tech space. Companies will come about, they will become large. But I still feel that, there are not many players where you can put your finger and say that, this is a place. I'll give you a classic example, Zomato. It's a market leadership status. I mean, you can't get better than, it's the only player in that sense, technically speaking, right? I mean, they charge, I run a restaurant business, they charge 20% from the restaurants. And they also charge delivery charges from the customers. At that scale also, if you are losing money, then when will you ever make money? Because, and it's that growth, pandemic was the best period for them Despite that, if you're losing money, then where will you ever make money? And then that company gets valued at a crazy valuation. So according to me, the business model is good, but it will not survive this kind of valuation. So there will be time you will find, people will realize, and already people are realizing, I think, that as the water levels have gone down, fundings have dried up, sanity is prevailing, and you are seeing them coming and talking about cash flow and reorienting business model, cost cutting, firing people. So all those things, what a normal businessman should do and would do, is happening. So I would say that one should definitely not close eyes on, keep eyes on some of these companies which are disruptor of the previous business model, because disruption is here to stay. How to benefit as an investor, how to make money from a disruption theme is a very different than business getting disrupted. We have seen that education, we talked about ever that India is a big opportunity, but has ever anybody been made money in education? So just because disruption is going to happen, your ability to make money from disruption is going to be limited, or going to be there, but as long as you have access to it and you understand that well. So I'm 100% sure that there will be lots of companies which will come about, but we have to be sane, rational in terms of risk management from those companies. I'm a big believer in new tech, disruption as a theme, but I mean, we will only sort of go into it as and when we are convinced that there's a risk reward and there's no madness happening out there. And that's what I would advise to everyone.
Yeah, thanks.
Mohit, just to add what I said, the USP of these companies, most of these companies, was always, whenever we meet them, that we disrupted the existing business models in a matter of years. They disrupted, but they forget that if you can disrupt somebody's 100 years old model in a matter of 2 years, even your business can be disrupted by some new technocrat, probably in a matter of few days or months. So disruptors can be equally, probably with a higher speed, can be disrupted, and therefore you cannot give the sustainability of that numbers. That itself probably is a question mark for most of the investors.
So got that. So you have to basically build upon defensible moats actually. So that again brings me to you, Anirudh, and it's a very interesting question that I have to ask, and I think there's a general consensus that I'm seeing forming up on banking, and I'm assuming most of you guys have been talking about or indicating towards the private banks. When we talk about BFSI, it has gone a much larger, area these days. It has got these public sector banks, then you've got insurance companies, asset management companies, fintechs, NBFCs, of course. So, are we talking about the BFSI sector as a whole to kind of, look at a focus area, or are we singling out the private banking domain out there?
See, to be honest, I would say I actually didn't have any of the private banks for most part of the pandemic. And I was actually on the other side. I had a company like SBI, which was kind of the top holding in my portfolio. So that gives you an indication that when I'm talking bullishness about the banking and financial, I would say we need to look beyond the obvious names. And as you rightly mentioned, I think banks is one part of it. Insurance is definitely a bigger part to it, wherein I would say the kind of insurance penetration we have in the country right now is extremely, extremely low. And if we are talking about the economy doing well, per capita income going up, etc., insurance penetration is inevitable. There are other, I would say, NBFCs, and the good part of NBFCs is that I would say during the pandemic, whether you talk about last 24 months, I think it has become evident that the boys have been separated from the men in the NBFC space. And that is where I would say after this period, the ones with a stronger balance sheet, they are emerging much evident that they will be the big winners. And, some of the fintech companies, you talked about the new age companies. Many of those new age companies were trying to disrupt, as mentioned by Rajesh, that, they're trying to disrupt the, 20-year, 30-year, 50-year-old model of many of the existing NBFCs and financials with regard to how you disburse the loans. Now, one thing the new age companies miss out is that, you are just a distributor. You don't have a balance sheet to kind of distribute. Unlike many of the old age financial firms who have a decent balance sheet, the people on the ground, and definitely the capability to do exactly what these new age fintech companies are doing. So I would bet within the financials, not just private banks, but beyond private banks, even the PSUs. Also, I would say NBFCs, insurance. So it's a broad spectrum of companies one should be looking at.
Wonderful. As we basically have got a kind of a very right perspective on the sectors, Rajesh, this basically brings me to the overarching question of what is the right valuation. We've got the answer of what and why. Now we need to get the answer of when. When should we basically look at entering out there?
You're right. I think, valuation, I always believe that, at every price, there is a buyer and seller, correct? So what is important is that, what is your time horizon? Number one. What are the inherent sustainability of that earnings growth? Number two. Because that earnings growth and the longevity of that earnings growth leads to the XP or X plus plus PE. For example, let me give an example. Say, for example, consumer company, Unilever. The earnings growth might be only, say, 10, 12, 13, 14%, whatever the number is. High, a single, early double digit. But the valuation, what it will command will be anywhere between, historically, last 10 years price to earning ratio of Unilever in India is roughly about 48 times. Correct. If you compare this versus, say, one of the steel company, number one company in the industry, despite 30% or 200% earnings growth, the valuation would be, say, 8 times or 9 times or 10 times price to earning. Because the longevity of that earnings growth is not very clear. Am I right? So more cyclical, the shorter cycle of your earnings growth leads to the lesser price to earning multiple. So what we look at is something different, little bit in a different way. We look at price to earning versus EPS growth. We look at price to book versus return on net worth. Once you do this, and then when you compare it with these 10-year average valuations versus the benchmark, so premium and discount and versus relative to other sectors, and then you say today, where are you into that growth cycle? That's fundamental question. I come back to that point, that what is very important for investor to understand is that where are you in that earnings growth cycle? Are you at the early cycle? Then you will not get PE cheap because there is no EPS right now. So PE will look like 30 times, but EPS growth will become 30% CAGR for 3 years. Same PE will look like 12 times, correct? So if the automobile sector, for example, where we are very bullish on both auto and auto ancillaries, the valuations are roughly, if you talk about any good OE player, say for example, Maruti or companies like that, you will get 25 to 30 times price to earning multiple. Because the earnings growth is expected to be very strong over next 2 years. Now compare this with two-wheeler players. They all are trading between 14 times to 18 times. Why? They are trading between 14 to 18 times because people are not too sure, the investors are not sure, because underlying two-wheeler industry growth is only 8 to 9%. And within that, there is a risk of EV versus ICE, correct? And it is that risk which further make a question mark. Will it be 5% earnings growth or will it be 12% earnings growth? And for 12% earnings growth, you cannot give more than 16 times price to earning multiple because PEG becomes more than 1 time, correct? So I think, it's always art and science in my view. The valuations are always debatable, at every price is a buyer and seller. But fundamentally, if you ask me last 10, 12, 20, 30 years of my experience, I've seen that the earnings growth is critical for their valuation to sustain. The software sector, you talked about software sectors, some time back, the valuation were 26 times because the earnings growth became 24%. If you look at the last 10 years earnings growth of IT company, it has been about roughly 15% compounded. And if you look at the Infosys last 15 years, market cap CAGR, it has been roughly about 14.8% compounded. Market is mirror of earnings growth. You need to make sure at what point you are buying, and if it is a cyclical sector, you need to exit because earnings growth, whenever it comes down, the PE will not be able to sustain.
Perfect. Thank you. Anirudh would like to add on to that.
The earnings, I would say definitely, taking an extension, I completely agree with what was mentioned by Rajesh, but I would say definitely valuations at what one would be willing to buy, it totally depends on whether you are buying in the bull market or in the kind of the pessimistic environment. Same companies, they are buyers even at 40, 50, 60 P, when there's a lot of liquidity driving the market. And same companies get sold at half the valuation, when the things hit the roof. So I would say that as long as I'm buying below 1 time PEG ratio, many of these companies, I think, you are definitely on a very, very comfortable footing that the margin of safety is on your side. So I would not pay a very high PEG ratio for, any of the businesses where I'm looking at an earnings growth. Definitely, you can increase the PEG ratio in some cases wherein, the earnings are going to grow exponentially higher. But typically to build in that margin of safety in any investment, I would say that is something I would always keep an eye on. And I would agree with what was mentioned by Rajesh about, the valuations which one should be looking at.
Wonderful. So, that brings me to an interesting part out here that I've kind of thought around. So what I'm going to do is, this would be more like a fast track mode, and I'll just ask you some optional questions. And all you need to do is, out of the options, just give me a single answer. I understand it will be difficult for you guys, and there's a lot of rationale to that, but I'll still urge you guys to probably look around there and answer it in a single mode out there. Okay, so Vikas, we'll start with you. So within BFSI, choice of yours: private banks, PSUs, NBFC, insurance, asset management, fintech, what?
Private banks, large private sector banks.
Large private banks. Okay. Coming to you, Anirudh. In the new age businesses, fintech, platform, edtech, food tech, gaming, logistics, SaaS, that's a bigger universe. I know. Choice is one.
I would go for the logistics.
Logistics? Well, that's very interesting. I wish I would have had time to understand that a little more. But then, nonetheless, coming to you, Rajesh, again, a simpler one, that we have to ask out there: export-driven businesses or domestic-driven, demand-driven businesses?
Base domestic, export is a topping on the pizza.
Exports are topping on the pizza?
Yep.
Oh, wonderful. We'll all love extra toppings out there. And with that, guys, this basically, I think, we are already kind of looking at end of the time out there. So, just to sum it up, guys, what we've basically been understanding is we've been able to get through this very interesting, rationalized understandings of some of these sectors that our experts have actually mentioned it, and these are some of the sectors which they presume are going to be, the leading sectors of the next run, which is going to get throughout there. On the win side or the valuation side of it, the prospectus is very clear that you have to focus around the earning growth. You have to look at the PEG ratios, and you have to basically look at your tenure as well as your comfort level. Basis that, you can place yourselves within the given sectors and the best of the stocks out there. But I think one thing that came unanimous out of them is that everybody is more or less on the same page with their sector choices and have been very, very bullish. Looks like they have a huge amount of conviction been building up into these sectors. So I suppose these are the sectors. But just for benefit of all, I am just going to kind of, look around the sectors for once more for everybody's benefit. Anirudh had actually taken his call on BFSI, housing in that, or real estate as a whole, if you basically want to look at it, auto and auto ancillaries, wherein Vikas had actually again picked up BFSI, supported with manufacturing, capital goods, and discretionary consumption. Wherein Rajesh again had actually gone more or less very commonly in capital goods, BFSI, auto, consumer discretionary, supported by specialty chemicals. So I think we have the picks very clearly laid out, and this is for all of us to kind of build upon the same. So with that, gentlemen, I'd like to thank you guys for sparing in this time and sharing this wealth of knowledge with us. And I think that is where we'll have to hold on this session. My apologies. Had we got more time, I'm sure I would have loved to dwell upon a little more into these things. But on that note, I'll be passing it on to you, Aishwarya.
Thank you very much, Mr. Bhagat. Ladies and gentlemen, our moderator, Mr. Mohit Bhagat, steered this conversation in such an engaging manner, and I think has brought the best out of the panel. Thank you very much to you, sir. And I'd also like to thank our esteemed panelists, Mr. Sarkar, Mr. Kothari, and Mr. Khemani.